Joining me now is Randy Smallwood. He's CEO of Wheaton Precious Metals. Well, congratulations, I guess, on the price of your output going up like this. So you're CEO of a company. You don't necessarily have control over the price of gold. But what can you do strategically in a period like this to lock in the benefit of what's going on in the precious metals market?
Well, we're longtime believers in gold. First off, John, honor to be here. We're longtime believers in the value of gold. And so our company, what we're paid to do is deliver profitable precious metals production to our shareholders. And that's what we have been building for 21 years. We created the streaming business model 21 years ago. And it's a mechanism that actually reduces the risk dramatically of a traditional mining investment, and yet still gives you all the upside benefits of exploration success, expansion potential, and commodity price. And that's what we're seeing right now is, of course, those returns and commodity prices coming back. And so our shareholders have access to really low-cost precious metals production through Wheaton.
So what's the difference in the type of capital investment that you're making versus a competitor that has a different model? How is that going to put you in a relatively better position no matter what the price of the end commodity does?
So we're a financing company. We supply financing to the mining industry. So we don't actually operate mines. Right. We have 42 employees in our company, 42 total employees. And so we supply financing to the operating mines. And what we do is we provide that capital. We purchase these contracts in advance to get access to some of their byproduct production. And usually it's gold or silver. We focus purely on precious metals. But surprisingly, most copper mines in the world actually produce a little bit of gold, a little bit of silver. And those copper miners, they're quite happy to sell off their gold to the Wheaton precious metals of the world, right? And so the bulk of our production actually comes as a byproduct. It's gold from copper mines. And that's the real advantage, is just getting access to that good, profitable production.
So given that you're doing that, to what extent do you need to watch the overall macro environment, say, which is going to affect something like copper, which is used in building differently than if somebody's concerned about the overall macro and they want to buy gold? Because it seems like you've got a bit more of a quantitative and risk assessment view in your model.
You're exactly right, John. You hit the nail on the head on that one. It's one of the things that I think we've prided ourselves on at Wheaton is focusing on technical aspects of our investments. And some of that comes down to the commodities, the main commodities that these mines are producing, and having an image on that. One of the best ways to protect ourselves on that is to focus on assets in the bottom half of the respective quartile or cost curves, the lower quartiles, the most profitable mines in the world. That's what we focus on investing on. So when someone approaches us that's trying to build a copper mine, we look at where that copper mine is going to fit on the copper cost curve. If it's in the bottom half of the worldwide copper cost curve, we know it's going to continue producing even in low time.